Today we're going to talk about the dirtiest secret in the market, except it's not really a secret anymore, which is kind of the problem. Bad actors can game the market by manipulating risk controls while putting the entire financial system at risk. I am talking about the growing influence of options gamma and how it can be manipulated by large traders. I first started to notice this change in the market back when posts on the popular trading subreddit Wall Street Bets first started to go viral with the whole infinite margin thing. Then we had the whole pandemic, the market mania that followed afterwards, and now options volume is significantly higher than it has ever been. And that popularity has given significant power to options market makers. Their hedging activity has become one of the most dominant non-fundamental forces in the market. And this is particularly true in equity indexes, where following the options gamma has become essential to understanding price movements. If you want to actively trade markets, you absolutely have to understand this stuff. So today we're going to talk about what gamma hedging is, how it can be manipulated, and how to account for it in your trading. We'll also discuss some proposed market reforms that can address the risks that over-leveraged trading poses to markets. So let's do it. So what is gamma hedging? Well, to understand that, I'm going to have to give you a quick primer on options. I'm so excited. We're going to talk about some super nerdy stuff today. No. Stick with me here. Trust me, this is some of the coolest stuff in finance. First, so make sure you hit that like button for me. It really helps the video out, and this is a video that we really want people to see. An option is a contract that gives the buyer of the contract the right, but not the obligation, to buy or sell an asset at a specified price before a specified expiration time. That price that you are able to exercise the option at is called the strike price. If the option is not executed before the expiration date, then it simply expires worthless. Now, there are two major types of options. Call options are for the right to buy, and put options are for the right to sell. So let's say you are trading options in the shares of company ABC, and you buy one call at a strike price of $10. One option contract in stocks typically controls 100 shares of the stock. This is an important detail, as that's where the leverage comes from. So executing that contract gives you the ability to buy 100 shares of ABC stock at a price of $10. Now, there are two sides to every transaction, and options are no different. In order to buy an option, someone has to sell it to you. The person that sold that call option, often called writing an option, will be obligated to sell the stock at the specified strike price if you choose to execute, regardless of the market price of the stock at expiration. Now, this can present a problem for the seller if they don't own any shares of ABC. This is called writing uncovered calls, and it's one of the riskiest things you can do. What if the stock price is already at $100 by expiration? The trader that sold the call will have to buy 100 shares of the stock for $100 each so that they can sell it to the option holder for $10. Writing uncovered calls basically exposes the market maker to unlimited losses. But there is a simple solution for the person writing the option. Just own shares of the company already. That limits their risk because they can just sell the stock that they already own. So a market maker may go out to the market to hedge their position every time they sell an option. But that's just where things start, because now we have to talk about the basics of Greeks. Greeks referring to the Greek symbols we use to refer to these variables. For instance, there is theta, which is the change in the price of the option as it comes closer to expiration. There's also vega, which is the change in the value of the option as the implied volatility changes. But what we really care about are delta and gamma. Delta is how much the value of the option changes as the value of the stock changes. So if the stock price goes up, the value of that option changes. It helps to visualize these things with a graph. I absolutely love these. The x-axis is the price of the underlying stock, and the y-axis is how much money the option makes. So if you buy a call option, you lose the option's premium if the price is below your strike price. As the price of the stock goes up, your option makes more and more money. We can draw the opposite graph for selling the call option as well as graphs for buying and selling put options. Anyways, delta is basically the slope of this line, except it gets even a little bit more complicated than that. Your options platform might have the ability to display these graphs, and you might notice that in your options platform, this line isn't straight. It curves, which it goes this way. It curves, and that's gamma. As the price of the underlying changes, the delta of the option changes as well, creating that curvature. This gamma is essentially an additional variable that options market makers have to hedge against, and this is kind of where our problem begins. See, when a call option is bought, the market maker will go and hedge their exposure by buying 100 shares of the stock. This will have the tendency to move the price of the stock up, but if you buy calls that are far out of the money, it will move the price of the stock even more because of the gamma, making these options a perfect tool for anyone wanting to cause a little chaos. And we don't have to look any further than the 2021 GameStop fiasco to see this in action. Massive numbers of retail traders were buying far out of the money calls, leaving the market makers scrambling to grab shares in order to hedge their positions. The perfect tool to create a short squeeze. Oh, but it gets so much better. Enter mark-to-market accounting. Mark-to-market is essentially a practice where current market prices are used to value portfolios. At the end of the day, the value of everything in the portfolio is marked with the current price. The value of that portfolio then determines how much margin you have the next day. In other words, a manipulator can come in and buy a massive amount of far out of the money calls. The options market maker will buy the underlying shares, pushing the price of the stock up. This will make the options that the manipulator owns worth more in the mark-to-market accounting and allows them to buy even more calls the next day. We recently saw some of this come into play with the whole Bill Hwang's Archegos blow up. Is that Archegos? Am I saying that? Look, that's not the name that I would have picked if I was starting a fund, okay? He was taking advantage of the mark-to-market rules to increase the amount of margin he had so that he could pump up his positions, except they took it a step even further and used the same assets multiple times at different broker-dealers to back their trades so that they would get even more margin that they shouldn't have been able to have. Eventually, the broker-dealers all figured it out and started to sell his positions, and it was ugly. Normally, this sort of thing isn't such a big deal because while buying has a tendency to move a stock up, the manipulator can't make money on that alone because they also have to sell. Selling into an already disrupted market can increase the impact of the sell, causing a loss on the trade. Remember, this is what we learned a few weeks ago in that stylized behavior of markets video. Think of it like a universal speed limit in markets that prevents traders from profiting just off their market impact alone, except there's a hack around this with options. You can just hold the options to expiration. Of course, such a strategy does not come without risks. All it takes is one down day to reduce the amount of available margin. This can then trigger a cascade that will completely unwind the trade. This scenario is explored quite expertly in a paper by some of my favorite researchers where they show how mark-to-market accounting can lead to a position that is guaranteed to blow the account. Their solution is that the impact of selling the position should be factored into the mark-to-market accounting. The closing price isn't actually the price you'll get because selling will move the market. The accounting rules should account for that. It's really quite an elegant solution to a serious problem that preserves market freedom and eliminates something that people really shouldn't have been able to do in the first place. Good luck getting legislators to care about such a complicated niche problem, though. In the meantime, what can we do about it? Or better yet, how can we make money from it? We can track current options activity. Options positioning doesn't always matter, and we often have a tendency to overestimate its effect. However, there are definitely situations where it can become a dominant factor. When options positions become highly concentrated around similar strike prices, it can create imbalances. Locations where the market becomes excessively long or short gamma. When the market is long gamma, this tends to have a dampening effect on prices. In other words, the price gets pinned to those concentrated prices, which can be quite frustrating for trading. When the market is short gamma, this can exacerbate volatility. This is particularly true in bear markets where liquidity is low. Moving below those key strike prices causes dealers to sell even more into already strained liquidity. I think this is why, since the pandemic, sell-offs tend to be so much more extreme. This also makes the monthly options expiration on the third Friday of the month a key point to watch. Take, for instance, the recent sell-off we had here in May of 2022. Markets sold off relentlessly for 7 weeks. That is, until the options expired, and then we've just magically floated up as all of those hedges unclench. Now, there are many paid subscription services that track gamma and other options metrics, the most prominent being Spot Gamma. I am not a subscriber myself, but I've learned a lot from their content, so they've definitely earned a shout out. They do have an affiliate program, so I'll be sure to generate one of those links for you in the video description below. A yearly subscription comes out to about $67 a month, which I understand is a little pricey for many retail traders. If you're looking to avoid picking up another subscription service though, there are other ways to get your hands on such info. For starters, Spot Gamma does have a YouTube channel that regularly posts information. It's another one of those criminally undersubscribed YouTube channels, so go check them out. That is after you've already subscribed to my channel and liked this video. I really appreciate it. Zero Hedge also regularly posts about this subject, most notably when they summarize research notes by Nomura's Charlie Miglia and Masanari Takada. It's becoming a more popular topic amongst traders, so you can often just pick up information from talking to other traders. The info is definitely out there, although probably not as thorough or consistent as you would get it from a subscription service. Now, realize that I am very much oversimplifying a very complicated subject. A video like this is a lot of work, and I'm sure I've made mistakes. So if you have any thoughts or questions, make sure you leave them in the comments. If there's enough interest, we can make more videos on this subject in the future. I really want to stress though how strongly I feel about this topic. It is one of the most important topics for us to address in finance. This endless cycle of over-leveraged traders expecting society to cover their losses needs to end. Don't get me wrong, I am very much a champion for the free market, but the market is not perfect. We should strive to improve the market in any way we can because such inefficiencies have real societal costs. It always seems to come back to this false belief that so many have that markets are fundamentally efficient. They simply aren't, and our rules need to reflect that reality. I will end with a quote from my favorite book. You know, this one, Trade, Squawks and Prices, Markets Under the Microscope. Prices are fleeting quantities, hypersensitive to fluctuations in order flow and prone to endogenous crashes. So why do we put so much blind faith in them? The belief that prices are faithful estimates of the value of assets, portfolios, and firms has dominated the study of financial markets for decades. Despite widespread adoption, this approach has many unfortunate consequences. Perhaps it is time for a better paradigm. So I'll leave you guys with that. I'll see you during the morning live stream, 8:30 Eastern time every morning. In the meantime, stay profitable, friends, or at least don't lose it all, please.